In today's video, let us understand the value at risk concept, a powerful metric used across finance to measure the potential losses. If you have ever wondered how big banks or fund managers quantify their risk, that is where they often start. By the end of this video, you'll not only understand what VaR is, but you'll also see how to calculate it yourself using Python. At its core, VaR is a statistical measure that tells us the potential loss in value of an asset or portfolio over a specific time. With a certain confidence level, it answers one fundamental question. What is the most I can expect to lose over a specific time horizon with a certain level of confidence? There are three components to any VaR statement. The time horizon. This is the period that you're looking at. Could be 1 day, 10 days, or even a month. The confidence level. This is the probability that your losses won't exceed a certain amount, commonly 95% or 99%. The loss amount, the actual dollar figure or percentage you stand to lose. So if I say our portfolio has 1 day 95% VaR of 1 million, what does that mean? It means that there is a 95% chance that our losses in the next 24 hours will not be more than 1 million. And conversely, there's a 5% chance that our losses could be greater than 1 million. It's an estimate, not a guarantee. So think of it like a weather forecast. There's a 95% chance that the temperature won't drop below 5 degrees Celsius tomorrow. It sets a baseline expectation for the potential cold, but doesn't rule out an extreme colder event. That's VaR for your investments. VaR became a staple in finance for some very good reasons. First, it provides a single digestible number. Imagine trying to explain the risk of a portfolio with thousands of different assets. VaR boils all the complexity down into one easy way to understand figures for CEOs, board members, or regulators. Secondly, it's crucial for risk management and control. Financial firms set VaR limits for their trading desks. If a desk's VaR hits its limit, they know they need to reduce the risk, perhaps by selling off some positions or hedging. And third, it's vital for regulatory compliance. Major banking regulations like the Basel Accords mandate that banks calculate and report their VaR. This helps ensure they're holding enough capital to absorb potential losses and protect the financial system. There are three main ways to calculate VaR, each with its own assumptions. We'll focus on the two most common methods today. The first one is the historic method. This is the simplest. It assumes the future will look like the past. You literally just look at your past returns and find the loss that matches your confidence level. The next is the parametric method. This method assumes your asset returns follow a specific statistical distribution, usually the normal distribution. Then you use the mean and standard deviation of those returns to calculate your VaR. The next is the Monte Carlo simulation. This is the most flexible, but also the most complex. It involves simulating thousands of possible future scenarios to model potential losses. All right. Now let's get hands-on and calculate VaR using Python. We'll use some real stock data. First, we need some historical data. We'll grab 5 years of daily stock prices of Google from Yahoo Finance. Then, we'll calculate the daily log returns of these prices. Log returns are commonly used in financial modeling because they are additive over time and have nice statistical properties. So this is a sample of how a daily log returns look. Now, for the historical method, let us set our confidence level to 95%. This means we are interested in the 5th percentile of our daily losses. Our code here calculates the 95th percentile of the losses or the 5th percentile of the returns. For Google, with a 95% confidence, our historical 1-day VaR is about 0.0315. This means, based on past data, there is a 95% chance we won't lose more than 3.15% in a single day. Next, let's calculate VaR using the parametric method. This method assumes our returns follow a normal distribution. So we need to calculate the mean and standard deviation of our historical log returns. So we store the mean in mu and standard deviation in sigma. Using these statistics, we calculate our VaR. So the parametric 1-day 95% VaR is 0.0329. This means we are 95% confident that a daily loss will not exceed 3.29%, assuming returns are normally distributed. Now let's visualize this. We'll plot a histogram of our daily returns and mark where our two VaR estimates fall. Here, you can see the distribution of Google's daily returns. The red dashed line shows our historical VaR, and the green dashed line shows the parametric VaR. Both are telling us where the cutoff is for that 5% worst case scenario. While VaR is incredibly useful, it's not perfect. It has some important limitations we need to be aware of. The first one is that it doesn't describe the day. VaR tells you the boundary of your expected loss, but it says nothing about what happens beyond the boundary. If you have a 95% VaR, you know losses won't exceed X 95% of the time. But in that other 5% of the time, the losses could be just slightly more than X, or it could be astronomically higher. VaR doesn't give you that crucial information. The second drawback is that it can be misleading. The parametric method often assumes normal distribution, but real financial returns often have fat tails. This means extreme events happen more frequently than a normal distribution would predict, leading VaR to underestimate true risk during market crisis. So, what's the upgrade? Many risk managers now prefer an expected shortfall, or ES, also known as the conditional VaR. ES answers a more robust question. If we do have a bad day, what is your average expected loss? Expected shortfall looks into the 5% tail and gives you an average loss value, which is much more informative for true worst case scenario planning. It's now the preferred standard for many regulators because it gives a more complete picture of tail risk. In conclusion, value at risk is an essential tool for summarizing market risk into a single understandable number. It's a great starting point for any risk discussion, but it's crucial to understand its mechanics. Be aware of its limitations and know that metrics like expected shortfall are often used alongside it for more comprehensive view.